It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. All right, Managing Your Financial Future. Boy, am I excited about today's program. Johnny Dean, your podcast host, not an advisor, but here with the advisor, Professor Rick Plum. Welcome back, my friend.
Thank you, sir. Thank you very much.
It's good to have you here. I wanted to get into, I'm going to get into this right away because this is a topic that's come up many different times off the air. And now that the markets are still somewhat volatile, I would say, have you noticed any volatility? I know we talk about it a lot.
Well, the issue is we always have volatility.
Yeah.
But for a long time, that volatility tended to be more on the upside. People don't seem to mind that type of volatility. They mind this negative volatility or this volatility to the downside. That's what really gets people focused on what's going on.
Well, and they shouldn't, because this is why you strategize, and this is why you have a financial advisor. I've heard people say, well, I hire a financial advisor because I'm going to get... I want them to get me 30% a year or whatever the number is. That's not why you have an advisor. You have an advisor for psychological reasons. You have an advisor to take care of the stuff that can be very, very complicated.
And a lot of what the advisor does is risk management, which by definition means you're not going to be, swinging for the fences every time you're at the plate.
Well, no. I mean, have you ever seen home run hitters? That's because that's a good analogy. You've seen them. What do they do? They either hit home runs
or they strike out.
Or they strike out. I mean, striking out can be a big problem when you're trying to work through your portfolio. So let's talk about this. In general, what I've seen, there are two different approaches.
In the basic theory, yeah.
Yeah, in general. Yeah. Two different approaches to withdrawals. Now, we're not talking about the savings portion. Most people know there is a savings portion of your life, generally, financially.
Accumulation, yes.
Okay, accumulation.
You're accumulating and building your portfolio.
Trying to get it up to where you need to be, and you tend to know, well, if I reach a certain amount of my portfolio, whatever that number is, I can make that last, I think.
Well, actually, I don't think most people think that way. They start building their portfolio, and they just try to build it to as large as they can in the hopes that when they do ultimately retire, they will have enough. Whether it is or not, they don't know.
Well, okay, there you go. Then that's
But
probably...
building a portfolio, the hardest part about building a portfolio is not the mechanism of the science or the asset allocation necessarily. It's the discipline to actually save the money.
Yeah,
to get it out of your checking account or your bank into an investment portfolio for the right reasons for the long term. But putting it for long term is easy. The problem with investing isn't building the portfolio necessarily. It's once you've built up that portfolio and you're looking at, is it large enough to support my income? Or you've done some math and you've got a good idea that yes, it is large enough. How do I transition that portfolio that I have been accepting of risk, that I haven't been looking at, that I haven't cared about what the market's been doing, that is just, over time it's been growing and it did fairly well. It's bigger than I expected. At least that's what it was a year ago. How do I transition that portfolio from a growth-oriented portfolio, which is actually very easy to deal with, to a cash flow, a distribution-oriented portfolio? That is a much more difficult management proposition than building a portfolio.
The distribution portion, the decumulation, whatever you want to call it, is the biggest challenge. Making it last, because
much more difficult.
You don't know how long you're going to last in most cases, and you just have to assume that it's got to last at least 30, 40 years, potentially.
New retirees especially.
In fact, you want it to go even longer.
I had this question just the other day. We were talking with a client that are in their mid-80s now, and because of the way they've actually spent a little less than they thought they would, they've been drawing down their buckets 1 and 2, and we'll go to buckets in a few minutes, but their long-term growth bucket has done very well over the years, and now is a larger portion of their portfolio than what somebody might think is prudent for an 85-year-old. It makes up.
In other words, there were more stocks.
There's more stocks in their portfolio
than there were safe investments.
But they still have enough cash and safe accounts in bucket 1 and 2 for 10, 12 years. But it's just that their stocks are now up to like 55, almost 60% of their overall portfolio. Now, it was a little higher 6-8 months ago, but The idea is, well, should somebody rebalance that portfolio now because they are overweighted in stocks by some people's opinions, or because the market's down, does it really matter? And the reality is it depends on whether it affects their ability to sleep at night. Their attitude was, I've got my income set for the next 12 years.
What do I care?
I'm going to be 97 by that point.
How much income am I going to need?
Well, am I going to need any?
Well, that's true.
Am I going to be here?
So let's.
But also, do I really want to rebalance today when the market's down 10, 15%? I can wait out, 10 years. So being overweighted in stocks by general rules doesn't mean you're overweighted in stocks. It's all about your specific situation.
Right, exactly. Maybe you value average. We'll talk about that. This is great stuff. All right, so let's compare the two. There's one that's a systematic withdrawal method of taking money out of your portfolio and living off of it.
Yeah, the most common, especially up until recent years, has been, as you get older, as you get towards retirement age, you decrease the volatility of your portfolio by taking money out of the stock market and putting it more into fixed income bonds and things of that nature that in historical terms worked differently. They went up maybe when stocks went down and vice versa.
Yeah.
They didn't this time. They all went down. But you try to lessen the volatility and you start creating a way to take a distribution from a balanced portfolio.
So you might
still only have one basic large allocation.
So you might have what? 50-50 mixture of stocks and bonds, 60-40 stocks, bonds.
Depends
whatever.
on how conservative or aggressive you want to be.
Right, but we've seen
those. You
those.
could take your age, your 100 minus your age, and that gives you how much stocks or bonds. I never know which one it is.
No, please.
That's a bogus one anyway. But yeah, you take a 50-50, 60-40 balanced approach to it, and you just start taking a distribution on a monthly or annual basis from that portfolio, and you rebalance it every year.
So if I got $1 million to make the math easy, if I have this and I decide, okay, $500,000 in stocks, $500,000 in bonds. I don't know if that's what they would do. You say I need $40,000 a year out of this. How am I going to get my $40,000? I got 500 in. I got 500 in one, and I got 500 in another.
Yes. So you set it up to be able to do what you want it to do, and you either take it out monthly. Or you take $40,000.
How do they sell half the stocks and sell half the bonds? How does that work on a systematic withdrawal?
Well, they typically will rebalance it as they take the money out. So if I take it all out of the bonds and then I rebalance it, now back to so I had to sell the stocks to replenish the bonds.
Okay, so
they're rebalancing, which means that even if I took it all out of one side or the other,
I got to sell one.
It's going to get rebalanced, so something's going to get sold to put it back to that 50-50 mark.
Okay, so it doesn't really matter one way or the other.
No, but typically what's happening is that you're selling it proportionally.
Yeah, okay.
And that's,
Okay, so
you can do it either way, but it ends up affecting the same way because you're going to rebalance it back to 50-50 or whatever your allocation was supposed to be.
Yeah, so I got $1 million. I'm taking 4% out in this hypothetical example. So 4%, but I'm thinking, well, okay, but if the market does 7% or 8%, I'm only taking 4%. Maybe I'm doing okay.
Well, and historically, the market has averaged, balanced portfolios have averaged 6-7%.
Sure. Okay.
Over time, maybe a little bit more in some cases.
Over time being the key.
Yes.
Now, here's the thing. What if I need 4%, but stocks are down 20 or 10 or whatever it is, and bonds are down, So
like they are right now?
Yeah. So now I'm really creating problems for my portfolio.
Well, I looked at one of the bigger allocation funds from a very large mutual fund company that has very low costs, and it's a very good balanced fund, and it's actually a 60-40 more on the conservative side, 60 more fixed income-ish, and year to date it's down just shy of 10%. So I mean that's one of the better ones, and so if you're taking a distribution from that, you're taking money out of a declining market. You're taking money out now each month, or you took it all out at the beginning of the year. I hope that would probably be better than doing it now. But you're down 10%. Your $1 million is down without taking any money out, down to $900,000. And if you're taking $40,000 out, you're down to $860. And you're hoping, or at least some portion of that.
But isn't that the worst thing you can do?
The worst thing that in investing is to sell something that is down that has a chance to recover. So I never want to be put in a position where I'm selling an asset that is in a negative return position that now it can't recover. That really hurts your returns. And so that puts me in a very bad situation. I just mentioned a minute ago, just in the way you take the distribution of that $40,000 we were talking about, that hypothetical $40,000. If you took it out at the beginning of this year, you're in a much better situation than if you took it out monthly coming into this.
But you wouldn't have known that.
No, because in the past years, it was better to do it monthly, let it grow each month.
So probably I've been doing it monthly. So I see all kinds of problems with this systematic withdrawal.
The problems arise when the markets do what they're doing.
When they go down. Now, if the market's going up and up and up, if we're
Who
up
cares?
20%.
Everything works.
But you're probably doing okay, if not pretty well. Yeah,
Oh, gosh,
right?
yes. When the market's going up, the only problem is that you think, well, the markets are always going up. I need to be more aggressive.
And
you start getting more and more. You go from that 60 bond, 40 stock to 50-50 to 40-60 to 30-70. So now you push the stock allocation. And we've seen that a lot with balanced funds over the last several years because the income side of the house was just paying nothing.
Right. It was paying nothing. And
so
here we go back to
they figured, well, if I'm earning nothing and it's got risk in it, if interest rates go up, why don't I just take the stocks and get the dividend off the stocks? That's a better deal. So they've pushed the allocations to more aggressive style allocations, even in balanced portfolios.
Well, see,
in many cases.
Here we go back to the hitting the home run or swinging for the fences analogy. And this is where the problem is, because you think, well, I'm getting softballs here. I'm just going to swing as hard as I can. Why not? And as soon as they do that, they get an unexpected fastball or change up. The market throws them a curve, right? And they swing as hard as they can and they strike out. So using that, I mean, striking out is bad in investing. If you're going to put all the money, it's kind of like throwing everything on, roulette wheel numbers, 5 or something. And it doesn't come up. You let it ride. So there are. I personally, I think you do too, see all kinds of potential problems with the systematic withdrawal.
If you're looking at the risk-return relationship of a systematic withdrawal, of being able to continue and not decimate your portfolio, yes, there are problems.
Yeah. So the risk is higher, and the return can potentially be higher.
Oh, in the good years.
Yeah, on the good years.
The
Sure.
return's great.
Okay. So let's compare this
Feast
now.
or famine? What is it? I mean,
But see, I don't like that. If I'm a retiree, I don't want to have that kind of risk. We turn to what you like here.
Right. I prefer the buckets
which
strategy.
is a bucket approach.
It's a time-segmented approach, and it attempts to put enough money in safer areas to draw down principal and interest to avoid having to sell assets in a down market to create the cash flow that I need.
Right. So let's go back again
Doesn't
over
mean
this.
that your portfolio isn't down. It just means that you're not selling it, or that portion of it, when it's down.
Okay, so let's go back to this $1 million again. Now, instead of doing 50% stocks and 50% bonds, which is a very simple way to do it. In fact, they have computer programs, I think, that can just do it and rebalance.
Oh, it does it.
Piece of
all
cake.
for you.
A bucket approach.
Yes.
You have $1 million. I need 40,000 of it. What would you, as a basic bucket strategy, do? Let's go over this again.
Very basic. You would put a certain portion of it, maybe 250, 300,000 of it. I'm just making the numbers off the top of my head here, into very safe, very potentially lower yielding areas, but that are liquid, available, and I can take 40,000 a year out of it, and I'm not losing any money on that.
So you're doing this for how many years? Are you buying a certain number of years worth of income?
Right, and so that's where the debate comes in. How much time do I want to be able to avoid the selling in the market?
Some people say, you only need 2 years.
Well, the average downturn is 18 months, and so that only gets you towards the bottom. I want it to be able to recover. So we want to have somewhere between 7, 6, 7, 10 years, maybe even as much as 15 years in safe or safer or moderately safe
relatively
investments.
Safe, yeah.
So in this first bucket I talked about, which was very safe, I was thinking about 6 or 7 years, give or take.
Okay, so I take...
But also putting enough money in there for unexpected issues. Also putting enough money in there so that if we have, 9% inflation or something of that? That was the last one I heard.
Well, that's annualized, but yes.
Annualized inflation.
Yes, right.
That I can take 42,000, 41,000, 43,000 out next year, 44,000 out next year.
Whatever it is.
And still have enough money to last the 6 or 7 years.
So I will take this, and say, I'm going to buy myself, call it 7 years worth of... So I might 7 times 40,000, 280, maybe $300,000.
Yeah, so I came up with it. I was going 250, 300, depending upon 6, 7 years. Give or
but
take.
let's call it $300,000.
Yeah.
So now you got 300. You put that into the bucket one, as they say, and that's going to provide me the income for the next 7 years.
I need, yes.
The cash flow for the next 7 years, or roughly. I've got it set. That leaves $700,000.
That means what happened this year with the rest of the money? I could be as aggressive, take that other 700 and go all stock market. And that 700 would have been down 15, 20% this year. But guess what? I'm not going to sell it for another 6.5 years at minimum. Now, in real buckets, we wouldn't have put all 700 into a pure stock market return.
You wouldn't only have two. You would have a
We'd have
middle
two or
bucket.
three. We'd have three, yeah. So we'd have a middle bucket that has moderate risk. And so maybe it's down, like that fund I talked about earlier, only 10%.
How much would you put in that? I got 700,000 left. Where am I? How much?
Maybe another $250,000 or so, 250,000.
Okay, so 250. Maybe call it 300 just to.
Yeah.
Or is that too much?
No, that's fine.
Okay, 300,000. So we take another 300,000.
That's being relatively conservative.
It is. It is being relatively conservative, but we're not trying to hit home runs here. So now that leaves 7 minus 3, $400,000 that I can put into.
Now, that 400, you've got 15 plus years for the market to crash and recover.
Because I've bought myself.
You've got enough cash flow for the next 15, 14 years. So the fact that your 400 is down to 306, 350 or something right now.
Whatever it is.
Yeah, it looks crappy on paper, but you don't have to sell it. And if the market averages, call it 7%.
Over 15 years?
Which is historically underperforming. Historically, over 15 years, we're typically more in the 9-10 range.
All right, but let's say you only did 7.
Your 400,000 grows back to $1.1 million.
So at the end of 15 years, I've spent all of my bucket one. Let's just pretend.
Yeah.
Although in reality,
you've overfunded it. You've set up for emergencies. You're set up for some inflation. Bucket number 2, you've spent that and even overspent that, and you still have $1.1 million left, and you're 80 years old.
In this example
with a 7% return, if it does do 10%, you got $1.6 million, give or take.
If it does an average 10% over those 15 years.
Yeah. Now I have ignored taxes and all this, but I consider taxes to be on the spending side,
yes,
rather than on the return side.
Of course, yeah. All right. So by buying yourself 14, 15 years of time, it allows, and not, I don't want to say not touching the stock portfolio, because,
well, this is where you don't necessarily set it and forget it, because you want to be able to manage it. You've by doing it this way, you have protected or tried to protect yourself from bad years.
You could set it and forget it, correct?
You could, but it makes
it's
it
not the most efficient thing, and it may not work as well.
Depending upon how you're managing it towards the end of the life of each of those buckets, you start adding risk in that area. So what you do, though, is because you've set up bucket 1 and 2, you have protected yourself against these negatives that happen from time to time where the market goes down. But the market doesn't go down every year. And in fact, more often than not, it's above expected return. We were saying 7, 8, 9% returns. Over the past 10 years, what you should be looking at doing is, what is opportunistic? Where can I take advantage?
Yeah.
But what about the upside risk that the market gives us? How do we take advantage of that? You identify where you think you should be. If I had 400,000 and expect a 10% return in the market for year over year, first year I should be at 440 after 1 year, right?
Well,
10%.
Theoretically, sure.
Yeah. So if I'm at 440, I'm where I'm supposed to be. If I'm at 420, I'm underperforming. Let's say that we had a great year. I'm at 480, 20% return like we had a couple years ago. Do I just let it ride? Well, that depends on you. It depends on where you are in your bucket cycle too. If you're your very first year, yeah, maybe you let it ride. Or if you're on the conservative side, maybe you take some of that excess return that it's over and above what you expected and replenish bucket number 1.
So in other words,
build your time horizon.
In other words, sell this hypothetical
stock.
Sell
the cream.
Sell when it's higher.
Sell when it's above expectation.
Take the profits and dump it into
bucket number 1.
And now you've bought yourself another half year.
Depends on how much.
Right.
Like in my example, if it went up 20%, it went from 440 to 480. That's 40,000 of excess. I just refilled bucket number 1 that I did for the year. So I just refilled a whole year of cash.
The psychological part of this, though, is somebody saying, wow, it's up 20%. Why in the heck? Wouldn't I let it ride? In fact, don't I want to buy more? And this is where I think
and that's where we got into trouble over the last several years. And that's why people's portfolios.
You mean investors got in trouble?
Yeah, investors. So when I say we, I'm talking about investors as a whole.
Yes.
We got complacent. We got expectant of these better than, 5, 8, 10% returns.
So people were saying, well, it only did, it only did 13%.
And so what's my option? Up until recently, my option was to put it into a bank account earning 0.0 nothing, put it into a short-term bond earning 1%, 1.5%. What am I going to put it into?
Yeah.
So their options in their minds were limited, so they stayed more aggressive in stocks, and they were rewarded for a little while. Now we're going through a period of time where we're not being rewarded, and so it's very difficult to beat the emotional aspects. And that's what an advisor and a strategy is helping you do. Like right now, if we're getting calls where people say, hey, I know I shouldn't have, but I opened my statement and are we okay? Well, let's go back to the strategy. Well, here's what's going on. Here's what you have. Here's where your income cash flow is coming from. Oh, okay. So I've got another 9 years before I have to worry about what this stock market is doing right now. I have another 10, 12 years, or X number of years.
Right.
Yeah.
What they were doing, though, if they're doing this, what they're implicitly wondering is, shouldn't I be selling some of these that are down to sort of stop any further losses going forward? Isn't that sort of what their mind is? Isn't this what they're asking you? Shouldn't we get out? Shouldn't we sell? And when it's down, shouldn't we sell at the low point?
Is this
sell
the low
when
point?
Well, you know what I'm saying. This is what their brain is asking you without asking you. And this, I believe, is where the psychological investor takes over.
Oh, yeah. This is all about the emotions of what's happening in the market. Mm-hmm. We see the negatives. Do we need to get out before it goes to zero? Well, it's not going to zero, but do we need to get out so that we can continue our lifestyle?
Cut our losses, right?
Well, if you're bucketized, you don't have to worry about that because your cash flow is set up for a number of years. Should I... this feels bad. What should I be doing? Got any money on the sideline? Let's buy in. What? You want me to buy in now? I didn't say I wanted you to, but if I had my choice, I'd be a buyer right now. People were very happy to be buying at the end of last year when the market was all-time highs. And those same generalizations.
Prices were high.
Prices were a lot higher. And now they don't want to buy in because it's on sale. Because they're worried about it being on sale more tomorrow, or whatever.
Yeah, of course.
Next week or whatever.
That's psychology. That's human nature.
And the problem with that is nobody knows for sure if the sale's going to continue through next week. We all have our opinions.
Yeah, but it may have already ended.
Right. I mean, we go back to 2009. Almost everybody was under the consensus in March of 2009 that we were going to be in for a much longer downturn.
Oh,
it was going to continue
the rest of the year.
I mean, the consensus was, man, they were just, go to cash. This is getting crazy. This is getting horrible.
Right.
And somehow on March 9th, something happened.
No, nothing happened.
No, I mean, something happened in the computers or whatever that started buying. And it triggered the bottom of the market and it started to recover. There was nothing we can point to that did it. There was nothing on the news. Somehow the downturn ended.
And but we didn't know it ended until months later.
Until we looked back and saw it.
Right.
And so those people that were getting out in February and March missed out on a fairly large run-up. And by the time they finally felt comfortable getting back in, they were probably, down 15, 20% from where they would have been if they just were able to just ride it out.
Yeah. And they missed their opportunity to buy when everything was on sale.
I mean, we've seen this multiple times with people that are very smart. I mean, we go back to this one example back 2011, a friend of ours knew that the S&P downgrade was coming. He got out of the markets. He thought it was going to roil the markets. It did.
Briefly.
For a short period of time. And he was the genius for a short period of time. Actually, he's very smart anyway. But
yeah.
But as from an investor standpoint, he didn't get back in until the market was 10 or 15% higher than when he got out.
I believe it was almost 2 years later.
Yeah.
I recall because I know who you're talking about, that individual.
It's hard to get back in once you've gotten out.
Well, because when you see the market going up, you're saying, "Oh, I got to wait because
it's going to crash."
As soon as it cocomes back down, I'm going to buy. It's a psychological game, and you're not going to win. By the way, you're not going to win over the long term.
That's going to hurt you.
So Bucket's attempts to solve this by not trying to swing for the fences, but being opportunistic where you think you can be. And by providing you the psychology so that you know that even if the market's down, I've got my next 7, 8, 9, 10, 11, 12, whatever years worth of income coming in. So I don't really have to worry about it.
Oh, yeah. I mean, that's part of the whole deal.
So what I see challenges, I've looked things up and I've said, well, Buckets has it's not perfect. I mean,
no,
it's not going to make you wealthy beyond your wildest dreams.
No, because in the good years, you're going to lag a little bit because you have money in safer arears.
But that's not why you do it. You
do it for the risk management standpoint.
Exactly. Implementation challenges. I was just reading this on one of the some websites. Tell me if you agree with this very quickly. It says the bucket strategy is very successful in terms of the psychological benefits to clients,
yes,
but there are some challenges with implementation. In general, there's a lack of standardized tools to calculate allocations across buckets.
That is true because there's a lack of standardization across people. Some people are more aggressive or more conservative than others.
Mm-hmm.
And it also depends on cash flows, especially if you have uneven cash flows where you need a higher income now than compared to later. Maybe your mortgage is paid off, maybe your Social Security kicks in. And so you have to be able to calculate that. So there is no standardized approach where you can just push a button and say, I'm 65, I have X amount of dollars, and here's boom, it's going to fit for every 65-year-old with that amount of money.
Yeah.
Because not everybody needs the same cash flow at the same time. They have varying amounts.
Well, they say there are a few frameworks that are used throughout the industry to help guide their creation, but there are no gold standards that everyone has come to expect to make things simpler from a buckets standpoint.
You mean besides us?
Well, we know how. I want you to say that.
I did say it.
You know how to do it.
Right, and we tailor it to each individual because I don't want a standardized across the board, one size fits all approach. I want an approach that fits you.
You've been doing this, 30 years?
A little over, yeah.
You don't do something for 30 years and not learn something about how it works. Okay, here's another challenge they say to buckets. I'm reading this. This is just off Investopedia, by the way. Portfolio reporting software may have trouble with a bucket strategy since these programs typically report on investments in aggregate or by account.
Correct. They look at it as a balance or as a one pool of money. They look at all of your accounts across the board as one pool of money.
Yeah. So if you've been spending down your bucket 1 and then your bucket 3 is down,
then it looks like what am I doing? Then it looks
right.
You have to take into consideration. There's a couple. If we work on them, we have them here, but that allocate it by bucket and by expectation, so that we can try to see where we are at via our journey through the buckets.
Here's one that I thought was kind of funny. They said, here's a challenge for buckets. While setting up separate accounts for each bucket may work, the cost of doing so may be too high, and some mixtures of retirement and taxable accounts could create headaches for advisors.
How is it going to be more expensive?
That I don't know. They did not explain that.
If I have a, well, I can't. I'm trying to figure out how to come up with that.
But headaches for advisors.
And if you're the client, who cares if it's a headache for the advisor?
You better know what you're doing, pal.
Yeah.
All right. I don't care if it's a headache for you. Right.
But it's not. If you know what you're doing, it's not a headache. It's just a puzzle that you put together and it works well. I think it's fun. I mean, if that other people look at the math. I mean, I do math with financial math, and we do things, and they look at me like, "You're weird." Well, I hope that's why they're looking at I'm weird, but I think that's fun.
Well,
and
it's
to
fun,
them, it's a massive headache to do that kind of math.
But that's why they hire you to do this.
Yeah.
And you got to know what you're doing. Finally, it says, here's a challenge for Bucket. Rebalancing can pose a challenge without the right tools in place to ensure proper allocations. Now,
there's two sides to that.
rebalancing.
First off, you shouldn't be rebalancing the buckets from 1 to 2 to 3 on an automatic basis. That's a value averaging concept, and you deal with it each year, each semi-annual anniversary that you're dealing with as you go along, as life changes, as you go along. It's part of the management of the overall situation. And then the last part of it, I can't remember what the last section was.
It says without the right tools in place to ensure.
Tools you need, that's part of the software, not software, but that's part of identifying, I'm putting this much in bucket number 1, 2, and 3. Bucket number 3, I expect X return. So in a year, I should be such and such. You've put those in your notes. You know what to expect. And you know how you're going to react based on where it is at that point. You have the tools. They're there, but they're not something that you can just plug everybody into the same computer and get the same output every time.
Like people do with the systematic withdrawal method, by the way.
Oh, very much so.
They just assume everybody does it the same way. So it's not rebalancing, it's value averaging. It's just another technique. Right. We don't have to get into it. You referred to it a little while ago, which meant that if you expected an 8% return and you got a 28% return, take some of that 28% and
right. And how you value average, how often you value average, it depends on the investments that you're actually using, and to some degree whether you're using them in a personal account or an IRA account, because there's no taxation to be considered if it's in an IRA. If you move from one area to another area, sales at gains hopefully don't matter, where they might matter a little bit in a personal portfolio. So what you're invested in dictates. If I've got a guaranteed account for my bucket number 2, that earns X% and it's earning that until the end of the 6th year, I don't need to necessarily value average because it's not going up more than expected. I know what it is. I don't have to replenish bucket number 1 quite as soon or quite as often. On the other hand, if I'm using a balanced portfolio that has some volatility, this year I mentioned they're down 10, 15%. And I wouldn't want to be, within 6 months of needing that money if it's down 10, 15%. So I would do value averaging more often with the more volatility that I'm accepting.
You see, I could see why some people would say, my brain can't handle this. I'm an advisor. I can't handle this. It's too complex.
If your advisor can't handle it, they shouldn't be your advisor.
Exactly. Boy, are we on the same page? I mean, I don't want a surgeon to say, well, you know what? There's a lot of ganglia in the brain and the axons, and I don't understand all this. I'm
not going to hire you as my brain surgeon then.
Exactly. You see, you have to know what you're doing for the job at hand, and there are only specific people that can do that. The bottom line on this Investopedia article was that buckets, while it's more complicated for the advisor, and the advisor better know what they're doing, it actually can benefit a client playing defense, if you want to say.
Well, I've also seen people that do the balanced approach, and they do the exact same portfolio in their IRA as they do in their personal account, but they're only taking distribution from one or the other. They're taking. They have totally different reasons for investing the money in those two accounts. One of them they're taking a distribution from, one of them they're not. Why are they invested the same way? Well, because it's easy. So they should be looking at how maybe we should be taking a little bit out of both. That's tax management. Or if I'm not taking any money out of the one side, maybe I can be a little more aggressive in that. So, but unfortunately, that's not the way the pro rata people do it. The systematic withdrawal people, they do it the same.
I don't want them saying, well, I'm doing it this way. You should probably do it another way, but it's easy. And I got a golf game, so I don't want to do it this way. Honestly, it drives me nuts that people would not take the time to learn it and say, well, a bucket strategy, I don't know, it seems kind of complicated. Let's just get a computer program, plug in the numbers, and it'll take 10 minutes.
It's nuts that somebody in a given profession doesn't know their given profession. I was looking at a tax return the other day, and the people had a massive tax bill. And I was like, what's this line? Well, I said, of course you have a big tax bill. You had $160,000 of gains, of capital gains. And they're like, my portfolio is $160,000. They moved it. They sold out the entire portfolio from one place and moved it to another place. They had $160,000 in sale proceeds.
Wow.
Not gains, sale proceeds. And
did they?
And I looked, well, who did you return? They said they had a CPA do it. It can't be a CPA. And it was. I mean, this is the only time I've ever seen this one. Most of the time, CPAs are right on the ball, spot on.
Sure, yeah.
I'll see this from a tax preparer from time to time. This was an actual CPA that put the proceeds down, not the gains. The gains were like 10 grand.
Wow. That's
their tax bill went way down.
Yeah. After you took a look at it, just because the CPA had it incorrect.
Right.
It boggles my mind. This is why we do buckets, folks. This is why we do buckets. I know you've got to get, I think you've got a meeting or whatever it is. I always grab Professor Plum when there's time. I appreciate you being here. If you want to know more about buckets and how a bucket strategy may be able to benefit you, talk to the folks at Lucia Capital Group, 800-644-1150. This is what they do. Been doing this, you said, for 30 years.
Yep. And we've been calling it buckets for since 93,
something like that.
Yeah.
And it's become a part of the lexicon. They've been doing this a long time. 800-644-1150. Also go online, luciacap.com. Find all kinds of resources there. luciacap.com. And learn all about buckets and tax management and all that stuff. My thanks to Professor Rick Plum. Did I say you're a CFP professional?
If you didn't earlier, you did it just now.
Good. Well, put a little registered trademark after that. A little R with a circle around it, because I think that's what it's supposed to do.
I think so.
For Professor Rick Plum, CFP professional, I'm your host, Johnny Dean. Thanks so much for listening. We'll talk to you again next time. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. A value averaging strategy does not guarantee a profit or protection from loss. The investor sets a target growth rate or amount on his or her asset base or portfolio each month and then adjusts the next month's contribution according to the relative gain or shortfall made on the original asset base. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Rick Plum is a registered representative with and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.